Well, good evening, everybody. Welcome to the latest session in our series of management accounting webinars. Before we start, can I just have a yes from everyone to confirm that you can hear the audio all right, that you can hear me speaking, please? That's great. Thanks very much. Okay, without further ado, let's talk about the payback period. This is a fairly popular task. We often get asked to work out the payback period for an investment. It is a straightforward procedure, but there are 6 popular errors that crop up time and time again. Tonight's session is designed to show you how to avoid these 6 errors. What we're going to do, we've got a scenario, and we're going to look at an investment within the scenario. And it's all about Roger's road repairs. And Roger provides a service to local authorities mending potholes. So, as you can imagine, anybody who's got a car, he's a pretty busy man because there's always plenty to do. His team are constantly fully booked, and there's always a lot more work available than they can get through. At the moment, Roger's team mends roads using only basic equipment. It means most of the cost of the service they provide is the cost of the labour. The work does demand quite a high level of skill to do it properly. Roger does not find it easy to recruit extra workers. And a further complication to Roger's business, he's agreed that if a repair fails again within a certain period of time, he has to repair it for nothing. And at the moment, this happens in 5% of cases, so for every 20 repairs that he carries out, he has to do 1 of them for free. Let's look at some data. Roger charges the council £90 for each pothole that he repairs. It takes his team of 3 people 1 hour to repair 1 pothole, and the costs for 1 repair comprise £25 worth of materials, 3 man-hours of labour at £15 an hour, which is £45. He has to pay a charge of £5 to get rid of the waste, the spoil that he digs out of the ground to replace with new material. So that the total cost is £75. So that means each repair that the team carry out, they actually earn a profit of £15. Roger's team currently can repair 500 potholes a month, and as we've said, 5% of those are free of charge. Now, a further twist to the tale, Roger's just found out that one of his best men has told him he's retiring soon, so Roger's got to decide what to do about it. We've already said he finds it difficult to recruit people with the suitable skills. It's not an easy job. So what's Roger going to do? He's thinking of investing in a machine called a road planer, which will automate the process, and the changes that this will make will be as follows. First of all, the machine will recycle and reuse the waste material. That when they dig the hole in the ground, they can use the same material to fill the hole in. This means they will still need to buy some new material, but it will fall to £23 for each job, and he'll no longer have to spend £5 for each job on a waste disposal charge. Secondly, the machine only needs 2 people to operate it, so the labour cost for each job will reduce to 2 times £15, which is £30. The quality of the repairs will be better than he can do by hand, and he estimates that only 2%, which is 1 in 50 rather than 1 in 20, will have to be repaired for free of charge. So that means that will free up more time to do chargeable work. Finally, how much is this machine going to cost? It'll cost Roger £500,000, and it will last for 5 years. On the face of it, for something that's to be used for a job that's £90 a time, that's a lot of money. But let's have a look. Let's carry out the analysis. What do we do? First step is we've got to work out what the current values are for the year of income and expenditure. Secondly, we've got to work out the revised values that will apply if this machine is bought. Step 3, we're going to put the 2 side by side and work out what improvement in cash flow the machine will generate. Having done that, We then need to tabulate for the life of the machine, starting from the point when it arrives to the point at which it can no longer be used, and work out what the cash position is year by year. And that will enable us finally to identify the point at which payback occurs. And that's the point when, having paid out, which puts us in a negative cash position, the point where we switch back from negative to positive, that is the point where payback has occurred. Now, at this point in our talk, this brings us to our first popular error. When you're doing an analysis like this, you must remember to take into account changes in both income and expenditure. An investment might result in an increase in income, it might result in a saving in cost, or it might result in both. It's very easy to take one into account and not the other, so maybe you're given a load of figures for improved sales, but you forget to take into account the cost of those sales. Remember, a penny saved is a penny earned. A saving in cost is just as valuable as an increase in sales revenue. So let's analyse that current situation in a bit more detail. At present, our income, £90 a job, we can do 475 chargeable jobs. That's because 5% of the 500 we can do, we have to do for nothing. So that's an income each month of £42,750. Our expenditure, first of all, we've got to buy 500 lots of material, because even the free jobs still need material to be paid for. At £25 is £12,500. We've got 500 lots of labour to pay, 3 people, £15 an hour, 22,500. And we've got to pay 500 disposal charges, one for each job, that's £2,500, total 37,500. Each month, Roger's team can earn a contribution, £5,250. If we roll that up to a full year, that gives us £63,000. That's where we are now, and we'll come back to that data in a few minutes. Let's look at the proposed situation. Our income will rise a little because we can now do 490 chargeable jobs, because only 2% have got to be done for nothing. That'll give us a monthly income of £44,100. Our expenditure will change. Material will drop now by £2 a job, so 500 times £23 will cost us 11,500. Our labour will fall because there's only 2 people to pay for. That'll be 15,000 for the month, and we will completely eliminate the cost of waste disposal. So our total costs will fall to 26,500 per month, which gives us a contribution each month of £17,600. Roll that up to a year, that's £211,200. Now our next job, we'll pop that original data back up into the corner, and what we do now is we'll tabulate the two situations and we'll put them side by side. So draw a table, income, expenditures, put the headings down the side. At present, our income per month, 42,750, material 12,500, labour, disposals, all the figures we looked at, they're on the card up in the corner. So that's where we are now. Now let's call up the proposed situation. And from that, income will rise to 44,100. Our material will fall, labour will fall, disposal will fall. So the overall contribution for the month will rise, and that's the situation for the year. So now we've finished with that card up there. Let's now look at the difference between the two. Income per month rises by £1,350. Contribution per month rises by £12,350. Each year, this machine will make an overall difference of £148,200, which either we can get by adding up the increase in income to the savings in materials, or we can get by subtracting the current contribution from the proposed contribution. You can cross-cast it just to make sure it all adds up. So this machine will be worth £148,200. That is the cash improvement it will generate, and that's a mixture of savings and of extra income. So let's just summarize that. When we do tabulate this, again, we could show each year the extra income and the extra saving, or in this case it's going to be simpler just to show them as a single figure. What matters is that you take both income and expenditure into account. And also this brings us on in a moment. Let's just list those out. So extra income 16,200, saving in cost 132,000. Again, it comes back to the 148,200. So popular error number 2, you must take into account the difference between where you are at present and where you're going to be. We can't just look at the cash flows for the new machine. We have to take into account the revenue we've already got. It's only the extra revenue and the extra savings that matter, not just the cash flows for the new situation. If it is a new project, you may be given an example. A company is thinking of setting up a project and here's the cost. Then you're comparing, if it's brand new and there is no existing operation, then yes, fair enough, the current results, the new results, will be compared with 0. But in one like this, where you've already got an existing operation, you've got to base your analysis on the difference. The popular error is to forget all about what's already there and just take into account the new proposed costs and revenues. So our next job is to draw a table, and we're going to show on here the cash inflows and the outflows for the duration of the project. The assumption we make is that cash is paid out at the beginning before any activity takes place. And usually this will be shown as year 0. Not always, and I'll come back to that point in a few minutes. We also make the assumption that cash is received once a year at the end of the year. In reality, obviously, money is coming in every day. But to draw a table with daily cash inflows is going to be a horrendous mess. So we bunch our cash inflows and outflows together once a year. We start at 0 at the very beginning, and then we assume a year has passed before we start getting any money back in. So there's a gap between the initial investment and the first of the income. So at this point, let's just call up that summary of our workings, and there it is. And this table, we're going to show our cash movements starting at the initial point where we pay out, year 0. And again, we do get examples where the writing says the initial outflow is year 1. I'll come back to that. It shouldn't happen, but it does. There's our table. So years across the top. Year 0, Roger buys the machine. He pays out £500,000. His cash position is £500,000 worse than it is before he buys it. During year 1, revenue or net gain in cash. Net gain difference between old and new is £148,200. Likewise, year 2, 3, 4, 5. You may be given an example where you're told cash inflow or cash saving, whichever, year 1 is so many £1,000. This will grow by so many % a year. In that case, you'd have to work out different figures for 2, 3, 4, 5. That in itself, it's just a case of reading the data carefully. In this one, this machine, it works at the same pace all the time. That's what it's going to earn. Next job is we're going to add another row to the table showing our cumulative position since the start of the project. Running total, if you like. So at the end of it, well, at the start, year 0, he's 500,000 down. When he's recouped 148,200, he's 350,000 down. 203. The end of year 3, he's still £55,000 in absolute cash terms worse off than had he not bothered. But by the end of year 4, he's showing a cash surplus, and by the end of year 5, quite a substantial cash surplus. So, looking at that table, what we'll do, I think we'll just keep that table up in the corner so we can refer to it. At the end of year 3, the cumulative figure is still negative. That's here, that's 55,400. The end of year 4, that's now gone positive. Payback has occurred sometime during year 4, and we would express this as 3 years and however many months. And on we go now. Popular error number 3. It's very easy to pick 4 as being the time that the cash flow is positive, and therefore it's 4 years payback plus whatever. It isn't. It's incorrect. What's happened is it's during year 4, so it's 3 years plus whatever. And we can illustrate this graphically. So if we draw a chart with time moving from left to right and our cash position shown vertically on the y-axis, at year 0, here we are at the start of the graph, we can see that we are 500,000 negative. Cash comes in each year, and here is the point at which we cross the 0 axis. That's a point at which we are neither up nor down on cash. Let's pay out cash at the start. There it is. There's where we cross the 0 line. 3 years and a few months. And I'm a great believer in proving things to myself visually. Let's count the years. 1 year, 2 years, 3 years. It's very obvious when you look at it like this that it's 3 years. And however, we'll come on to the months in a second. If you look at it graphically like this, you know, it can never be 4 years. But that is a very, very popular error. I've mentioned months. Let's look now at the number of months. How far negative is it at the end of year 3? It's 55,400. We divide that by the total movement during year 4 and multiply by 12 to convert a fraction of a year into a number of months. So, end of year 3 we're 55,400 negative. Year 4 we go positive 148,200. Divide one by the other, that's 0.374 of a year, a bit more than a third of a year, times 12 months, 4.48. We'd round that to 4 months. So our answer in the case of Roger's proposed road planer acquisition, the payback period is 3 years and 4 months. Now, we'll come back to that graph in a second. I mentioned that there are times when a badly written question says that the initial cash flow is in year 1. In this case, we count 1 and then year 2, the money comes back, 3 and 4 and 5. We still make the same assumption that the cash inflows start a year after the start of the project. And if we look at the graph, the time difference is exactly the same. This time we're counting from 1 upwards rather than from 0, but sure enough, there's where we start. 1 year, 2 years, 3 years, 3 and a bit years, so it is still 3 years and 4 months. Personally, I would have a rule that says examiners are not allowed to write questions that say the machine is bought in year 1. It's just misleading. But again, mathematically, it's not difficult as long as you understand this. Just remember that. I mean, the error that people make here is they'll calculate that as 4 years, 4 months, which is wrong. Deduct the starting point. In this case, we're starting at 1, we're ending at 4. So you still get 3, just the same as 3 less 0 is 3. So it's an easy mistake to make, but if you look at it logically, you'll be fine. That's the calculation part. There are just a couple of other points now other points, 2 more popular errors, in fact. So we've finished with that graph now. We'll just put that graph away. Number 5, quite often when asked to calculate the payback period, it'll be combined in the same question with the requirement in the next section to use discounted cash flow and discount factors and so on to calculate the net present value of the project. When you're calculating payback, you must use actual cash flows, not the discounted cash flows. It's a very popular error. You're just looking, it's simple, what cash came in, no discounting, no calculation, how much cash improvement was generated, the actual figures, not discounted. And then last of all, popular error number 6, often you'll be asked to make a recommendation as to whether or not a project should go ahead. You may be told company requirement is that payback is within so many years, and you'll be told also company requirement is that the net present value at a certain percentage is positive. If you're asked to state whether a project should be given the go-ahead on the basis of your analysis, if you're asked to calculate both payback and net present value, then both criteria must be satisfied. If a project meets one criterion, maybe it meets the payback requirement but falls short of the net present value, or maybe it meets the net present value requirement but doesn't achieve payback, it must be rejected. That might not be the case in real life, where there might be a little bit more scope for negotiation. In an AAT question, if both criteria are not satisfied, then you must recommend the project is rejected. And remember the own figure rule. If you've made a mistake and in fact one of your figures is wrong and it should have been a yes, you will get the mark on the own figure basis. A final thought. One other thing that I've seen a mark or two for, you might be asked to comment on whether payback is useful or whether it's not useful. You may be asked for an advantage and a disadvantage. And a couple of easy ones to remember. Payback is useful because it gives some measure of risk. The sooner you get your money back that you've paid out, the sooner the safer the investment. If a project takes maybe 4 or 5 years to pay back, a lot can change in 4 or 5 years, whereas a 2-year payback period comes around a lot quicker, and there's less chance of circumstances changing and it all going wrong. There is one big weakness, the easy weakness to remember for payback. If you compare 2 projects side by side, both have similar payback period, one of them runs for 8 years, the other runs for 5. Payback takes no account of cash flows that take place after payback has been achieved. It only goes as far as payback, and that is all it tells us. And that's really all I have to say tonight. My colleague Alan is manning the chat panel if anybody's got any questions. So any questions? If not, thank you very much everybody for listening, and good night.